2021 marked the very first year that home prices increased on average more than what the average worker made in an entire year. Think about that. You could have sat at home all year long on your couch doing absolutely nothing, and more times than not, your home would have gone up in value more than what you would have made actually going to work every single day. I bring this up because most millionaires, in fact more than 90% of them, own real estate of some kind. And that fact right there, the fact that you could earn tons of money, your net worth could increase substantially just by owning real estate, is an important fact to drive home. But unfortunately, as you probably already know, interest rates have gone up dramatically, making that same home that would have cost you much less with a lower interest rate much more expensive today. Take a look at this graph. Interest rates have gone up faster than they've ever gone up in history before. And to top that off, home prices themselves have gone up on average 18% nationwide. And in some areas like Tampa or Phoenix, they've gone up more than 30%. I'm curious, comment below where you live and how much home prices have gone up around you. Let's put some real numbers on this. Suppose you got a $400,000 mortgage to buy a home back in January. That mortgage would have cost you $1,647 a month based upon a 3% interest rate. Now today, with interest rates at a minimum of 5%, that exact same mortgage, that exact same home would cost you $2,147 a month. And with interest rates at 6%, that would cost you almost $2,400. That's nearly $700 more than it would have cost you just in January for the exact same home. But if you would have bought in January, you would have bought at a time with historically low inventory. And even today, we have fewer homes on the market for sale than virtually any other time in history. Well, don't worry, there's good news. And by good news, I mean actually quite bad news. The Federal Reserve is scheduled to raise interest rates more than 5 times for the rest of the year, making mortgages likely significantly more expensive. Because if the Federal Reserve raises their interest rate, all other interest rates, generally speaking, will go up in comparison. You also have firms like BlackRock buying up literally tens of thousands of single-family homes and then turning around and renting it right back to the very people that would have probably purchased them as their starter home to begin with. Now, while BlackRock and those other firms only own around 2% of the single-family rental market currently, it is likely that they're going to significantly increase their purchases of single-family homes on the orders of billions and billions of dollars a year because it is getting so expensive for regular people to go out and purchase it. They figure they buy it, they could rent it back to the very same person that would have bought it in the first place. In fact, in February alone, 25% of all single-family homes were purchased with all cash, meaning rising interest rates didn't matter to them because they were purchasing with cash, not a mortgage. That further compounds the effects of trying to get your very first home. So what exactly are you supposed to do? Well, in this video, I'm going to give you 4 things that you could do to try to get your very first home, despite all of these headwinds facing you, rising interest rates, low inventory, etc. I still believe firmly that for a lot of people, it makes sense to buy that very first home. Not for everybody, and I have a video as to why you shouldn't buy a home if you want to check it out. But for most people out there, for one reason or another, whether it be personal or financial, they probably want to get that very first home so they can get on the property ladder. So we'll be covering a couple ways that you could do that if you're looking to buy your very first home. So please comment below with any questions you have. Like this video, it really helps the channel out. Share it with anybody that you think it might be interesting to, and subscribe if you're not already. My name is Kevin Conway. Now let's get right into the 4 things that you could do to buy your very first home. Okay, number 1, there's something called an FHA loan, otherwise known as a Federal Administration Home Loan. This is a loan that you can get and have to only put down around 3.5% to purchase that very first home. I'm really surprised more people don't talk about FHA loans in the context of buying your very first home, because you can get an FHA loan with much less in the way of financial capacity, and like I said, you only put down 3.5%. That is a far cry from the typical 20 to 25% that most lenders will want you to put down to purchase a home and borrow money to do so. So here's the keys with the FHA loan. You need at least a 550 credit score, at least 50% or less debt to income ratio. You need to put down 3.5%, as I said. This needs to be your primary residence, and you need to have mortgage insurance premium. Let's break down each one of those individually. So let's just say you're gonna buy that $500,000 home. 20% down, that's $100,000 of cash that you need to put on the table just to be able to go get a mortgage. With an FHA loan, by contrast, that $500,000 home, you really need to put down just a little bit less than $20,000. Okay, your credit score. Your credit score is very important. You probably already know a thing or two. There's many credit cards you can get out there that actually show you what your credit score is. There's free tools you could use online, both of which I will link in the description below, tools that you could use to check your credit score today. But suffice it to say, the higher your credit score, the lower interest rate that you can get on a mortgage. And for this FHA loan, a minimum 550 credit score, that's very low. But if you have no credit history at all, you need to begin developing your credit history. So please look at this video that I made a little while ago on how to get a credit score, how to increase your credit score, because it'll save you money not only on this home loan, but on virtually every other home loan that you go and get. The 50% debt to income ratio is pretty straightforward. What are your outstanding debts and what is your income? How much does it cost you to service those debts relative to your income? So if you make $5,000 a month and you have credit cards and car loans and student loans and they total $2,000 a month, well, that's not 50% debt to income ratio, that is 40%, because you divide the amount that you service your loans with, $2,000 versus the income that you have, $5,000. That is 40%. If you have a 50% or low debt to income ratio, an FHA loan is still on the table for you. Next, this needs to be your primary residence. This needs to be where you have your mail sent, where you call home. It's pretty straightforward. Likely it's not going to be an investment property for you, but just keep in mind you can't use this for investment properties. There's one small trick where you can earn money on your FHA loan, which I'll talk about a little bit later. It's kind of an investment property hybrid. It's pretty interesting. I'll cover that in just a moment. And lastly, the mortgage insurance premium. This is an amount of money that you pay both up front when you get your FHA loan to your lender, and you pay it on a monthly basis going forward. This is essentially insurance for your lender just in case you default, because actuarially, you are more likely to default with a lower credit score and a lower amount of money down. That's why your lender requires you to have this mortgage insurance premium. Now, the unfortunate part about the mortgage insurance premium with FHA loans is that it stays on for the life of the loan. You pay up front, like I mentioned, which is about 1.75% of the cost of your loan, and you could actually roll that into your loan balance. So you could actually not have to come out of pocket for that. You could just tack it on to your loan and pay a little bit, tiny bit more every month, because you're going to be carrying that in your loan balance. But you also have a monthly mortgage insurance premium, which is some amount of money. Usually for your loan, it's going to be around $50 to $100 a month. It depends. It's a specific percentage that your lender will determine in order to get you that loan. Now, you can get rid of that mortgage insurance premium if you put down 3.5%. If you put down 10% after 11 years, it goes away, but that's not what I'd recommend if you're trying to get your first home. I would recommend putting down 3.5% to get in the door, and then at some point later in the future, you could refinance your FHA loan with a normal loan if you have sufficient amount of equity in your home at that time. Let's just say a couple years down the road, you've made some payments, your home has gone up in value, and now you have 20% equity in your home. You can go get a regular mortgage, refinance out your FHA mortgage, and get rid of that mortgage insurance premium. But like I said, this is a first-time home buyer program. FHA loans are great for getting in the door, quite literally, and don't worry too much about that small amount of money that you're going to be paying in mortgage insurance premium, because you'll have your very first home. So what kind of homes can you buy with this FHA mortgage? Well, there are certain limits on the amount that you could borrow, but what's really interesting is that you can actually buy a home that is duplex or a triplex, or even a 4-unit complex. You can buy condos, etc. So what some people sometimes do is use an FHA loan to buy a duplex or buy a triplex or whatever and rent out the additional rooms. Of course, you have to live in one of them as your primary residence. You can rent out the additional units to help cover your mortgage. That, I think, is a really smart idea for a lot of people because it can help offset the amount of money that you're going to be paying for that mortgage. It's a whole lot better than renting yourself because you're going to have renters. Now, of course, things could go wrong and you need to be aware of the costs that come with renting something like that to different tenants. So if their stove goes out or whatever, you'll be responsible. But this right here is a really interesting idea for a lot of people if they want to buy a home and eventually maybe start owning a real estate empire of their own. Got any questions? Leave them in the comments below. Now, point number 2 is something that we already covered a little bit on, and that is improving your credit score. The reason why I bring this up as its own standalone point is because improving your credit score won't cost you anything to do, but it'll save you a ton of money and allow you to get a mortgage that is bigger than you otherwise could qualify for with a lower credit score. So if you increase your credit score, all things even, your debt, your income, all other things even, if you have a higher credit score, you can borrow more money or you can borrow money cheaper than you could if you had a lower credit score. That's why it's so important to get your credit score improved. Just take a look at this here, a 600 credit score versus a 700 credit score. If you have a 600 credit score, your mortgage is going to be higher. It's going to cost you more than if you had a 700 credit score. It's pretty awesome. So what are some things that you could do very quickly to increase your credit score? Well, first off, you need to know what your credit score is and how it's calculated. That's why I recommend checking out this other video. But the quick and dirty rule is you need to actually lower the amount of money you have in credit card debt and other debts and actually increase the amount of credit capacity that you have and keep your utilization, that is the amount of money that you use on those credit lines, very low. That way your lenders think that you're a low risk. You need to pay your bills on time and not miss payments. And pretty much that's it. There's a few other things you need to do. But again, consistency and a few tricks here and there can really increase your credit score. All right, number 3 is a little bit out there, but I'd recommend looking at low cost of living areas you can move to and trying to get a remote work paying job. Today, it's 2022, which means that you can get remote work paying jobs a lot more often than you could even a couple of years ago, thanks to the pandemic, I guess. So look at this list right here. There's all sorts of different cities that you can move to, great cities you can move to that are way cheaper than, for example, the coastal markets or other big cities, and you could still get a very good paying job. What's also interesting is that because so many people are moving to these kind of cities, home prices are actually increasing substantially over time. So it could be a double benefit if you get a home now. Okay, and last, number 4, the way to get your very first home is to not go to your bank for a mortgage. I know that sounds counterintuitive, but here's what I mean by that. You need to have a mortgage broker, somebody who brokers your personal financial situation to different lenders to have them compete against one another to give you the best possible rate and the most amount of money you can borrow. You do not need to just go straight to your bank. Your bank may end up being the best option, but probably it is not. Now, here's what I mean. If you go to a place like Costco, for example, I know it sounds strange, but Costco has a Costco finance section. This is essentially a mortgage broker area where different lenders will compete for lower rates, lower points, lower everything for your business. You type in your financial information and then boom, a bunch of different lenders come up that you could choose, and you could choose a couple of them, a couple of different ways. That way you can get the best possible rate. Don't just go walk into your bank and ask for a mortgage, because chances are that will not be the very best rate. That won't be your very best deal. It may be more difficult to get that very first home if you're constrained on the amount of money that you can borrow by your bank, or the interest rate on your bank's loan is going to be too high. Going and using a mortgage broker, whatever the broker may be, you could just Google it, mortgage broker, is going to be a much better option than going just to 1 or 2 different sources. So those are the 4 tips. If you have any questions, leave them in the comments below. I know it is a tough market out there, but trying to get your very first home, especially in this inflationary environment, is probably the right thing to do. As they said, they're not making any more land and rent isn't going down over time, so you might as well buy your first home to defray some of that inflation in the future. If you guys have any questions, please let me know. Please don't forget to like this video, and I'll see you next time. Thanks.